Are the volatility control indexes that have really been making a surge in these last few years in the new different products within IUL good to include in your indexing strategy? If you're watching this video, I assume you are a little bit more experienced with IUL and looking at the nuances of the products and the different indexes and strategies. As I mentioned, a lot of different companies and products have been coming out with these new indexes and really marketing with them, saying, look, we have this new volatility control index, and if we backdate it, it has a really strong return. Or for example, they might have very high participation rates. All of these can look very appealing on the surface, but I'm gonna kind of go over what I use as generally a rule of thumb when looking at any of these indexes for kind of judging whether or not it's something that I might actually consider for putting my own money in. So the very first, and I actually just touched on this, is the backdating and the inception date of the index. When they have an index and they say, for example, like the Barclays or a BlackRock Andorra or something like that, what we need to note is they might say, hey, over time in history, this has averaged, say, 10%. We're going to add this index and we're going to put a higher participation rate than 100% on this. Well, on the surface, that might seem very exciting or very appealing. But what we need to do is look at when this was actually started. So that's the inception date. And then we need to look at the backdating and how they got that data. What this is essentially what backdating is saying, hey, this index has only existed since 2019, but if we carried it back out 20 years before that, it would have averaged 10%. The problem with this is a lot of these indexes have got much more popular since 2008 when the market crashed, and the reason is people will look back and say, well, yes, the market went down a lot in 2008. Was there any strategy that we could have deployed that really would have been able to avoid this and still get good gains over the history of time? Well, when they look back at 2008 and say, oh, this specific strategy, if we would have been in these indexes and had this much in cash and this much in treasuries and whatever, that would have saved us, we're gonna do that, and now we're gonna tell you guys, hey, this index has averaged 10% over this long period of time. It's not really fair because they're kind of taking the answers for what can we do to prevent something happening in the next couple of years from after that period and after it's already happened. Problem is, this strategy may very well have prevented 2008, but not all market crashes are a carbon copy of 2008. That's why backdating and kind of getting the strategy from that and looking at the average return based on the backdating is a little bit flawed and a little bit concerning in my opinion. That's why you want to look at the inception date. So what has it actually averaged since inception date? And maybe it even has averaged 10 or 15%, but what period of time, how long has it been around? Is it something that was born in 2019? Well, now it's only 5 years later, and yeah, it's averaged 10, but we only have 5 years of data. It's not like the S&P where we have hundreds of years of data. So that's the very first thing. All you need to do is Google actually the name of the index. You can copy and paste it, find the report page on that index, find its inception date. You can look at the averages from after that. And then also you can kind of look at what were they actually backdating from, and is this kind of a fair analysis of how this may perform in the future. The second thing I like to look at, and this is something you can find doing the same thing, so Googling it, kind of looking into the index, is what is the split of how they're actually investing this money. For example, the whole point of these indexes and why they're called volatility control indexes is they are setting a target for their key volatility number. So if for example, index has a volatility rating of 5%, well, that means they're trying to do, or what their goal is to make sure that it's pretty rare that index is not going to gain or lose more than 5%. So they're keeping it in something that's going to have lower variance than it might be if you're in something with a volatility rating of 15%. Now, what they do to accomplish this goal is they're going to spread out over different things. So maybe it's some bonds, maybe it's treasuries, maybe it's cash. Sometimes, just to make sure that they keep that target volatility rating, so let's say it's 5 or 5.5%. Well, if the treasuries and whatever else that they're in kind of shoot up to where that's causing the total volatility to be, say, 7%, they might pull some of that money and put it in cash. This money is not going to gain anything, but since a big portion of your money is in cash, the average volatility of the three things that their money is in turns out to be 5 or 5.5 or whatever the goal is. So one thing to look at is where is the money, and especially how much of this money is in cash. Because I've seen plenty of times, even after the inception date, where you can look into an index and you can say, 34% of my money's in cash. All right, nice, I'm hitting my volatility rate of 5.5%, but why would I be in an index where 34% of my money's in cash when I could just put that portion that's in cash into a fixed account? So again, something to look out for is just where they're putting their money. And lastly, I think it would be difficult for me to justify getting a specific product because of one or two volatility control indexes that they have that look very appealing. While you can certainly make arguments that this is the case, one thing that I always like to look for is what are the fallback options? What I mean by this is if these indexes, for example, start converting more money to cash than you expected, or maybe the participation rates are dropping over time and they're not something that you can take advantage of into eternity, but only for a few years, what are you going to have to move those into? Are they crediting their fixed rates a fair amount? For example, some companies are crediting you 5% on a fixed rate, others might be just above 2%. So is that a good fallback option if you wanted to move into a fixed account? Second is almost every company has an S&P index, but what's their cap? If the company has a fallback option of an S&P with a cap of 8.5%, well, that's not very competitive compared to industry standard right now. Out of the three kind of points in this video, if I had to pick one of them, this is probably the most important, is kind of looking for those fallback options in these cases. So in summary, first I'm going to look at the backdating and the inception date to get a fair view of the index. Second, I'm going to look at where is this index actually keeping my money? And third, if they went to crap, where would I be able to fall back in? What would the other indexes that I would go into, or even the fixed account that I would link my money into? If you found this video helpful and you are wondering, maybe you have your own IUL and you're wondering if your own indexing strategies are optimized, these are the methods that I would use to kind of evaluate them. If you want help doing that, you can always book a call below, a free 20-minute consult. I'm happy to do that. Most of the time in these cases, especially if it's structured properly, all we're going to be able to do is just you can put in your own request to change your indexing allocation by yourself, regardless of what the agent has to say. So I'm happy to just point you in that direction. You're not going to have to do a 1035 exchange, start a new policy, or you go through underwriting, whatever it might be. So even if that is the case, you can feel free to book a call below. I'm happy to kind of point you in the right direction and help you fix the indexing strategy and even just build that relationship. I do post videos Monday to Friday. Not all are this technical. This is one of my more technical videos, but just around my whole retirement philosophy, why I'm a big advocate for IUL in many different scenarios. If any of that sounds like of interest to you, I do ask you to subscribe, and I will see you in the next video. Bye-bye.